This presentation is going to cover what are the working paper entries when you have consolidated financials with a non-controlling interest, referred to as NCI in the presentation. And we're going to look at the equity method and then see the different entry that we'd have to make if we had used the initial value or partial equity method. Now, as a refresher, as we know, under the initial value method, all we do is record the initial investment and we do not make any adjustments to that account for any share of income or share of dividends or amortization. For the partial equity method, we do not adjust the account for any amortization. So we're going to take a look at those entries on the working papers. We're going to start, and here is our example. We're going to use the same example for all three methods. And on January 1st of 2016, Mike Tech acquires 70% of Danny Tech for $560,000 cash. The 30% had a trade value of $240,000, and Danny Tech had common stock of $400,000 and retained earnings of $200,000. A patent was undervalued at $50,000 with a 5-year remaining life. Danny's net income and dividends for the 3 years were a total of $590,000 in net income and $140,000 in dividends. At December 31st, Mike Tech owed Danny Tech $25,000. What are the worksheet entries? Again, we're going to look at the equity method, the initial value method, and the partial equity method. First, what we want to determine is, was there a premium on this purchase, and is there any goodwill? We'll start with a premium. We're going to take the $560,000 that the parent paid plus the fair market value of the non-controlling interest equals $800,000. And then we're going to compare it to $560,000, which is what the parent paid, divided by their share to get 100%, which is $800,000, which means there is no premium since these two numbers are the same. Next, we're going to determine goodwill. We're going to take the $800,000 consideration. We're going to less the net book value, which gives us a difference of $200,000. We're going to assign $50,000 to the unamortized patent, divided by 5 years to get the annual amortization, and then we are going to come up with goodwill of $150,000. Now we can do our working paper entries. Okay, the first entry we make is entry S, which we remove the subs equity accounts and recognize the non-controlling interest. So we're going to take the common stock off the books at $400,000. We're going to take the ending retained earnings of the sub, which would be the $200,000 plus 3 years worth of income minus 3 years worth of dividends, which gives us $650,000. And that total equals $1,050,000. And then we're going to take 70% times that to get the investment in Danny Tech. There's a balance in the account, and the non-controlling interest would get 30% of that number. The next entry we're going to do is we're going to recognize the unamortized portion of the fair value allocations. So the patent now having been amortized for 2 years as of the beginning of 2018, because we would not have recorded on the books the $10,000 for the current year 2018. We book the goodwill $150,000, and then we're going to allocate that between the investment in Danny and the non-controlling interest. Next, we're going to remove Danny's net income recorded on the parent's books only. That's all we care about. And so equity in Danny Tech is going to get 70%, which is the net income of the sub for 2018, minus the amortization, which is what would appear on the books. And we're going to take that to the investment in Danny account on the working papers. Next, we're going to eliminate the current inter-entity dividend transfer, which would be the $70,000 times 70%, and take the dividends declared off the books. And then the last thing we're going to do is, next thing we're going to do is amortize the patent of $10,000. Remember, record 100%, because when we're doing the acquisition method, we always take 100% of everything and then we adjust. And then the last thing we're going to do is we're going to eliminate that intercompany transaction by taking the accounts payable off the books and the accounts receivable off the books. Now that's how we would have done it under the equity method. Now let's look at what happens if the parent has used the initial value method for the investment in sub. The initial value method ignores two accrual-based adjustments. The parent does not accrue the percentage of subsidiaries' net income earned in past years in excess of dividends, and the parent does not record any amortization when we use this method. So therefore, we have to use what we call entry C, which is added to the worksheet to convert the previously recorded balances to the equity method. So entry C is used to convert. We are going to combine the increase since acquisition and subsidiaries' returned earnings during the past years, net income less dividends times the parent's ownership percentage, and the parent's percentage of total amortization for these same past years. Entry I removes both inter-entity dividend income and subsidiary dividends to the parent. Entry D is unnecessary. So we're going to have our initial investment. So now we're going to look at, well, what should the balance be like in the investment account? We had our initial investment account, which is what's showing on the books. We then need to adjust for net income and dividends for 2016 and 2017 times 70% less 100% of the amortization for the 2 years. No, I'm sorry, 70% of the amortization for the 2 years, which gives us, which would only be our share. So what we're saying is we have to increase that account by $154,000. So we're going to do entry C, which would adjust the investment account, Danny Tech, 154, and retained earnings to get us beginning retained earnings of 154. Now, what would it look like if we'd use the partial equity method? Well, as we know, the only thing we have to worry about is the amortization. So if the parent used the partial equity method to account for the subsidiary after acquisition, entry C is used to convert. In this case, only the amortization expense for the prior years must be included. Under the partial equity method, the parent accrues its share of reported subsidiary income, but it does not recognize any acquisition date excess fair value amortization. So again, we're going to look at how do we have to adjust the investment account. Well, we know that it's already been adjusted for prior year income less dividends. So the current balance under the partial equity method would be $828,000, but we need to adjust for prior year amortization 70%. So this would be entry C under the partial equity method. So we would have to adjust beginning retained earnings and of the sub and investment in Danny. And that ends the difference in the three methods presentation when we have consolidated financials with a non-controlling interest.